Good morning and welcome back to Almus Market Mornings, where we bring to you the latest developments in the financial world. The dollar has started its rise again from the lows, as we have kept saying these are narratives which keep changing. A weak economic number leads to expectations of Fed having to remove its feet from the throttle of rate hikes, leading to a weaker dollar, and a strong economic number or any other indication that the rate hikes can continue leads to the opposite. We had the US jobless claims data indicating that the labor market is still strong, leading to some dollar strength. While all these narratives aside, it seems our domestic currency, USD INR, has a brain of its own. Just like our domestic equities, which seem to not have a sell off like its global counterparts, USD INR did not see much of a correction during the corrective move of the dollar. I mean, if you look at our peer China, Chinese yuan moved from 7.26 to 7.02, while USD INR didn't come off much from its high. In fact, yesterday we saw a very strong closing after the spot close with USD INR touching 82 plus after the market close. Morning, JK. What are your thoughts on the move? The overall dollar correction did not seem to have much of an impact on rupee, while some recovery in dollar led to such a strong move. How are you reading this?
Good morning. Yeah, definitely the rupee movement yesterday took the spotlight of the interbank as well as the corporate community here. Why I say interbank is also because the movement of the currency after the bank closing hours was very significant, and that is very rare. Move of 40 paisa after the bank closing rate is reminiscent of the moves that we used to see in the NDF market some time back, and that was something everybody was upset about, and that was happening right in front of our eyes in our own futures market yesterday, which nobody expected. A lot of unhedged or uncovered positions of certain banks are being blamed for the move, but in any case, there was no supply that was coming. Apparently, there were supplies from the central bank around 81, 85, 90 levels, which was keeping the dollar subdued. But once they moved out, the movement was phenomenal, and a lot of stops got triggered. In any case, the opening was also higher because OPEC decision directly impacted the Indian macros. Higher oil price and adding to the higher trade deficit that we are running. So it was justified, but I think breaking through a previous high has never happened at such a pace, and also within such a short time, and that has actually dented the sentiment. One should expect that the sentiment will remain weak today unless there is a larger intervention from the central bank to keep things calm. I would expect them to intervene today because in their own words, they don't encourage volatility of this type, although the move is also associated with the movement higher in the dollar index. So it has to be another action-packed day, maybe two-way movement, unlike yesterday. But now looking ahead, dollar rupee, now again we are in a new uncharted territory. Projections again become very difficult, but it looks like just ahead of the new round numbers are becoming the resistances, and once it stays above 82 for a few days, then the next resistance would be seen near about 83. Unless there is a big change in the overall dollar index and the macros. And on the other markets also, the specter of higher inflation, higher yields, and elevated hawkish approach from the central bank has again come to haunt the markets. In fact, two former US government officials were vocal in their call for Fed remaining on course for higher rates, without which the inflation cannot be controlled. In a think tank interview, Lawrence Summers, who was a former Treasury Secretary, called Fed to move to terminal rate of 5%. Thus taking the interest rates well beyond what the dot plots have been suggesting. He also said that we are unlikely to achieve inflation stability without a recession of a magnitude that would take unemployment towards 6% range. Another former official of White House, Jason Foreman, wrote that the Fed's actions so far are not doing enough. Until actual inflation starts coming down, Federal Reserve should not even consider changing the course. So all these things had a negative influence on the market, and the yields once again moved up in both 2-year and 10-year in excess of 10 basis points. Of course, the OPEC decision to cut production at 2 million barrels per day, which was trigger for dollar rupee moving initially. Also, it had its impact on other currencies because the inflation will be higher again, and central banks will be on course to rein in inflation through higher rates. At the same time, possible recession will be on the cards because the activity levels are slowing down. In fact, the yields which had somewhat subdued because of Bank of England's actions last week, also saw the spike up even in the gilt yields because it's going to be a temporary action from Bank of England, and it's going to expire on October 14th. And with other macros not supporting a lower yields, again, we are seeing a big selling in the bonds. In fact, Indian bond yields have also risen to 7.48 from the low of 7.30, which was just seen on the day of monetary policy last Friday. Currencies, of course, Euro and JPP have given up a lot of gains which they made since last week. Euro, in terms of percentage, more because there was weak German factory orders at minus 2.4%, and they have been now declining for the last 6 out of the 7 months, and highlights the probability of Germany getting into a recession later this year. Eurozone retail sales were also soft at minus 0.3%, and the annual number now stands at minus 2%. So nothing to write home about the Eurozone economy. It's definitely slipping into a recession, and the UK has problems of its own because of the fiscal stability that the market is worried about. Commodity currencies, they had a surprise rally yesterday, but they gave up all the gains back once the US yields started moving up, and also the stock market started coming down. We are now all focused on US monthly jobs report today, which could flesh out much of the tight labor market. Tight labor market is loosening after low job openings in JOLTS data, higher jobless claims. Possibly the NFP is expected at 250 to 260,000, and that would be the most sluggish performance since December 2020. Unemployment rate is expected at 3.7%. But even though such a number could be a comfort for the market because that moves Fed towards a pause, expert opinions call for unemployment rate to reach at least 6% before the central banks can see the inflation really falling. The other focus obviously has been the Fed policymakers' speeches, and a lot of them are scheduled today also. Much of the debate is now concerning where the terminal rate would be, and that is now it's probably tending more towards the 4.6%, which the dot plot had indicated. Some, of course, indicating 5% also. But two statements are slightly contrarian. Fed's Daly, who yesterday mentioned about the strong dollar having its impact on other economies, which the Fed cannot ignore totally. And secondly, Fed Kashkari, while broadly sounding hawkish, said that there is a risk of overshooting. So these are slightly different statements from what we have been hearing overall. And it's a time when we have to be biased towards stronger dollar, higher yields, and because inflation is still ruling at double digits in many major economies. So there's no relief for the risk assets, no relief from dollar rally, and the global trade and the global growth are really remaining challenged. And the NFP data today would just only be passing act, and we really have to look beyond that. Thank you.
Thank you, JK. And as JK mentioned, today we have the NFP data that can cause some more volatility in the markets, especially if the narrative of the dollar strength continues, we can have some more upside. While On the domestic front, we need to see how RBI reacts to the rupee depreciation, which is ongoing. That's it from us today. Keep managing your risk. We'll see you all next week with the latest round of updates. Thank you.